Let's get into private credit now. And will APRA's proposed hybrid changes lead to a rise in demand for alternative credit? Frank Daniele joining us from MA Financial to discuss. Frank, good to see you.
Andrew, good to be back.
So this is all off the back of this, well, it's proposed, but it's actually been ratified now. Are these changes coming in terms of removing these AT1 hybrids?
Look, I'm sure there'll be a consultation period, but APRA's come out with a proposal and a paper on this, and it's a pretty bold proposal with a series of changes to the bank capital structures, but in particular a transition away from AT1 hybrids, which are in particular those ASX traded hybrids. Banks will have to use more tier 2 hybrids, which are sort of institutional bonds and a bit more equity.
And what's prompted this change?
Well, I think APRA's really just trying to simplify bank capital structures, and it's looking at these particular instruments. They're very complicated instruments, and saying, there's actually other alternatives that banks really should use, and I guess APRA's always got a lens on broader financial stability and limiting systemic risk for the banking sector.
Okay, so what are the alternatives?
Yeah, well, look, there's a lot of capital in this space. There's $43 billion in these AT1 hybrids. A lot of that is in the big 4 banks in Macquarie, about $38 billion worth, and the investor base is sort of split in two. There's some institutional investors. I think those kind of investors probably just rotate into tier 2 bonds, over-the-counter institutional bonds. But these instruments were really appealing to high net worth and retail investors as well. You can buy them on the ASX or in a much more accessible form. They deliver income regularly, and on top of that there was sort of like a franking credit element to it as well that attracted people. So really popular instruments amongst the retail and high net worth community, and I'm sure they're going to be looking for a home, because unlike institutional investors, they can't just rotate the capital into the bond market, because that trades over the counter and it's institutional.
So where are those retail investors likely to go then, do you think? Well,
think about what they can do. I mean, I guess they could buy shares. They could buy the bank shares instead of these hybrids, which are a hybrid between debt and equity. That brings with it more risk and more volatility, so maybe some people do that. I must say our banks are the best capitalised banks, I think, in the world, so we've got a really high quality banking system, but just owning equity is different to owning a debt instrument.
Well, and you probably haven't done too badly if you've been invested in the big banks recently, have you?
Well, especially if you're in CBA, you're still doing well, despite the fact it's off its all-time highs. But it is a different instrument if you're seeking something that's just consistent yield. What else can you do? People could invest in bond funds if they want to get access to those more institutional bonds. But I think there's a range of other products that people might look at. They might look at things like listed investment trusts that give them access to other types of debt. They might look at private funds. They could look at private capital funds. I think if you're really seeking income, if this is the defensive part of your portfolio, then people are going to be looking for a home. So there's winners and losers, and this is something where it actually brings over time quite a large amount of capital that will be looking to support other types of lending. It's actually not a bad thing for the economy. If it goes into lending funds, then that lending can go out into the economy, can support companies, corporates. We might see more corporate lending grow. We might see other types of finance for the real world economy emerge as well.
And what's the prospect, perhaps, and you mentioned this ASX listed tier 2 bond market then developing?
Yeah, I'm not sure about that. I think in APRA's paper, they talk about the return of an ASX sort of tier 2 market being something that could add risks of either mis-selling and or create, systemic risk. That's something they're trying to limit. So I'm not sure that happens, which means, again, these ASX hybrids that are out there, people are going to be looking for an alternative. I think that the winners here are things like either the listed investment, trust that can be out there. There can be more of those that can come to market. Alternatively, it might be people putting money in some of these open-ended private capital funds, because it's going to give you that same kind of thing, capital stability with more consistent income.
Yeah. So on that point, is it possible that investors are more likely to take on greater risk then, as a result?
Well, if you kind of think about what you're doing with the hybrid, these are really complicated instruments. Again, they're complex instruments. They happen to be in the best capitalised banks in the world, so the experience has actually been quite good for investors. But if you go into some of these other alternatives, then what you're doing is you're providing capital to someone who's going out and making loans. if you buy a bank hybrid, what are you doing? You're giving capital to a bank that's then going out and making loans. You don't get a huge amount of transparency as to what's in the bank's balance sheet. It's extremely complicated, especially for a retail investor. So I think in the right structure, with the right type of reporting, governance, infrastructure, all of those kind of things in the vehicle that that people will rotate into, whatever that happens to be, then I don't think they're necessarily taking more risk. And people have choices. They could buy bond ETFs. They could buy they could buy private capital funds. They could buy other types of alternative credit, or they could buy even shares that are dividend paying if they want to. And I think people will do a whole mixture of that. But I don't think this capital is going to, this capital is there for a reason. It could be a self-managed super fund investor seeking that consistent yield. It could be a retiree. They need income. They need that kind of yield generation. I think that they're just going to look for alternative forms of yield. And, hopefully, I guess the financial infrastructure can create the right products for them. And I think they're probably actually already out there.
Assuming, and once these changes are put into place, what do investors need to do?
Well, this is going to play out over time. So, there's sort of like a 2032 backstop date where APRA doesn't want any of these things to be called. So, in the interim period of time, there's going to be lots of so it's not going to be like $43 billion tomorrow is going to all of a sudden look for a home, but there's going to be billions of dollars perhaps per annum that's going to be refinanced. People are going to get that capital and they're going to look for alternatives. I think, as I said, I think that what you're just going to see is that people are going to look for some of these other alternatives. They'll look for what are now these retail private credit funds that are available out there. They'll look for bond funds. They'll look for ETFs. They'll look for, and I think the listed investment trust market, which post the changes to stamping fees a few years ago, sort of became a lot more quiet. I think there's an opportunity for that to come back in the same way that in the United States the public traded BDC market is very active. I think you'll see more of that. And that just means there's going to be more choice. So I actually think it's going to be a good thing for the market and good thing for investors who need these ASX traded securities.